Hey traders, Marcello here, the founder of the Day Trading Academy. I want to talk a little bit today about what is a futures contract. You know, in the 1990s, futures contracts, especially E-mini futures, exploded. So I want to explain, since we've been getting a lot of questions on the topic at the Day Trading Academy, about what a futures contract is. In order to explain how it works, I want to explain where they came from. Back in the day, you know, when farmers existed, they needed to have a reliable source of income. And as the price of agriculture, like corn, pig, pork bellies, all kinds of things, fruit, coffee, since the prices of those things fluctuated, farmers needed a way to be sure that they were going to have an income and know what price they were going to make. There also needed to be a medium of exchange, a centralized medium of exchange, to be able to tell what the prices were going to be. Much easier that way. So farmers would make agreement with suppliers to buy a contract which expired in the future to buy a certain amount of products. So normally, one contract of coffee, for example, might be 1,000 barrels of coffee. One contract of pig bellies, for example, might be 1,000 pounds of pig bellies. So as the financial markets continued to develop, this futures contract, this financial product, was applied to other financial instruments. So now, instead of just placing a futures contract to buy a physical product, what we're doing now is we're buying a financial product. And this allowed a lot of arbitrage, like hedging, for example. If you and I are in coffee, let's say, we're here in Colombia in our day trading center in Colombia, where we teach a lot of the locals how to invest. Let's say that we have a few coffee farms and we now want to expand to coffee farms in Brazil, in Venezuela, and maybe even other countries in Africa, and we need to sell the coffee to the United States. There's going to be a certain level of risk that comes with selling coffee that's grown in Colombia, local currency is pesos, to the dollar. So what people started to do is they started to hedge their risk, or in other words, limit their risk by playing the financial markets. So you could place a futures contract, for example, to bet against the value of an index or even a currency. So now what you could do is you could have an agreement to sell your coffee in the future, but then also limit your risk if the dollar goes down by betting against the dollar. So as the expiration of your contract for coffee comes up and the value of the dollar goes down, you betted that the dollar would go down. So you're actually making money as the dollar goes down. Okay? Now, eventually what happened is something was created called E-mini futures. Now, the futures contracts for financial products like the S&P 500, for example, are hundreds of thousands of dollars. So the CME, the Chicago Mercantile Exchange, the main futures exchange in the United States, decided that they wanted to make a little bit more money. It's all about making profits, right? So they decided to open up a new financial product called E-mini futures. The E-mini futures is 1/5 the size of a futures contract, and it's only traded electronically. And they opened up this E-mini future to allow traders like you and I, with a lot less funds, to be able to speculate and make money in the stock market. I do have to thank them for that, because that's how I've been living my dream for the last 6 years, being able to day trade and travel around the world. So E-mini futures is primarily what we trade at the Day Trading Academy. It's what we teach even though the concepts that we teach can be applied to stocks and Forex and everything else. So hope you understand what a futures contract is now, how the futures contract exchanges work, and also how the new E-mini futures contracts works as well. As always, if you have any questions, leave us a comment below here on YouTube or a question, and you can always reach us at thedaytradingacademy.com. Stay profitable.